Hello, everyone. This is Stephen Richardson, and today we're going to be talking about how to invest in stocks. If you've watched some previous channels, I've shown you about the quality check and the judgment, and now we're going to put it together and talk about how exactly to invest in stocks. Okay, here's a standard disclaimer. I'm not offering financial advice, and this should not be construed as financial advice. It's just education only. Okay, why better investing works. It's a common sense approach. Has education information. The stock selection guide is great for researching, and there's webinars and all kinds of teaching resource, regional teaching available. Lots of resources, and there's community support. The first the first ticker, first cut stock ticker where someone will talk about a stock that they've researched that's published and everybody can see it. And there's a magazine too that you get every month. Um, it's just a really good deal. Better investing. It makes it easy to invest for studying stocks. Okay, so better investing's philosophy: stock investments should be in growth companies and viewed as a long-term basis. This is not for short gains or get rich quick. It's for long-term growth companies who are great companies. You focus on the company performance, both proven and potential, not emotional swings of the market. Earnings are the ultimate driver of a stock price. Only consider buying a stock when the possibility of achieving an adequate return is good. You might hear at the Coke machine somebody says, "Oh, this is a hot stock, my brother." You shouldn't avoid that urge to go buy that stock. You should do your research, your due diligence first. All right. So the principles of investing there are four. Um, it is buy growth stocks, invest regularly, reinvest the dividends, and diversify. These four simple principles are going to help you as you build your personal wealth. They'll help you a lot. So, long-term stock investors, they identify good quality growth companies, verify quality company characteristics. We talked about that the other day. Estimate the company's potential. We talked about that the other day, and determine a fair price to pay for that potential. Okay, so doing your homework, you need to analyze growth and evaluate management, the visual analysis, and examine past and do research, build a comfort level. Then you forecast the sales and earnings. We talked about that a little bit. Estimate growth potential for next 5 years. That's where we look, that horizon is 5 years. Then you analyze the risk and reward, estimate the high price and the low price for the next 5 years, and then valuation and return, potential upside and downside for this stock. Okay, investing in growth quality stocks. Remember, we talked about green is sales, pink is potential or pre-tax profit, and blue is earnings per share. We talked about good companies are up and to the right, they're straight, and they're parallel. And these are more or less parallel. Got a little blip where you had a lot of profit and a lot of earnings one year in this company. This is FactSet, by the way. Um, Upright, up, straight, and parallel. Okay, visual analysis helps us identify quality growth companies. Strong and consistent sales growth, strong and consistent earnings per share, steady and growing pre-tax profit, steady and growing percentage earned on equity, and debt to capital less than 33%. So evaluating management, this is where you evaluate the pre-tax profit, the return on equity, and the debt to capital. You look what is trending. That's a big thing. Even is good, up is good. Well, up is not good for debt. Um, Down for ROE is not good. You want that to go up. This company's at on average 51% the last 5 years. So that's really high. I'm going to have to dig in and find out why it's more than 33%, because that's a lot of servicing the debt interest. Okay, now what? We need to have a good understanding of the company's future prospects. Now that we've got the quality check and we've done a background and looked at it, you got to dig deeper. Your research will uncover the company's potential growth potential. Using this information combined with the understanding of historical performance, be prepared to make forward-looking estimates regarding the company's future sales and earnings growth. This is the bread and butter here, making forward-looking estimates that are reasoned and not just emotional, let's say. Okay, so on the SSG, you have a cutoff here where it shows historical information for fact set, right? And then based on what you input into those green boxes, it forecasts the future. And you can see I put some figures in here. 6% for sales, 6.1% for earnings per share. And it projects out 5 years where the revenue should be and what the stock price should, the earnings per share should be. All right. So then you have to figure out the now that you've done the sales and the earnings, now you have to figure out the high forecasted price. So the the high forecasted price is your judgment on the price earnings ratio. And you can see we have a 5-year average, high average, 3-year average, and the current. And you choose and this is a separate class by itself, doing the price earnings ratios. And then the high forecasted EPS, that was from your forecast previously based on 6.1% EPS, that equals the price that it's going to be. $728 is what you're saying it should be in 5 years. Okay, calculating the forecasting the low price. So you're going to enter what you think the low will be in 5 years. And you can see they tell you the 5-year average low, the 5-year average, and the current. And you pick something reasonable. Again, there's another class for this. And then it takes multiplies that times the current um, earnings per share. And that gives you a forecasted low, what you think the low will be. Okay, and based on this, this is a 25, 50, 25. So which is conservative. Aggressive will be 33%, 33%, 33%. So when uh, a stock is within its 25% of its low, forecasted low, it's in the buy zone. When it's in the middle here, the next 50%, that's in the hold. And when it starts getting up to 728, that's when you're thinking about selling or trimming to take some profit and maybe use the money elsewhere. Okay, 5-year potential return, the total return, the rate of return of an investment over a certain period of time. There's two components, the capital appreciation and the income appreciation. Income is dividends. Some company have dividends, some don't. That's figured into that appreciation, that return. All right, and so on the potential return, there's an upside downside ratio that's calculated for you, and this one is 1.9. Remember, you only want to invest at upside downside ratios that are greater than 3. So this is telling us that it's a hold, and we've got a red here on the total return, the high PE. So this is definitely a hold. It's not a buy. Hold on to it for if it appreciates in price, you can sell. How to study stocks, better investing stock selection methodology. You evaluate, remember, this is a recap. You evaluate the management, quality, visual, your judgment, then you forecast the sales and earnings, and then the valuation and return, that potential worth is what you look at. So now what? Now that you know how to do it, this is a valid question for beginners. Now what do I do? So first you need to find a broker, then you need to create an account with that broker, then send cash to the broker. And then when it's in the broker's account, then you decide what and when to buy or sell. You make the decision. So there's some well-known brokers over here on the left are Interactive Brokers. I've used them before. Charles Schwab used them before. E-Trade, we use them in my investment club that I'm a part of, the San Francisco Better Investing Model Investment Club. And then JP Morgan is another one. And then some less known brokers, public.com, SoFi, Robinhood, Acorns, and Moby. If you're familiar with Robinhood and Acorns, they've got a program where they'll take it's like a spending card, and any change left over will go into a savings account. So, like something costs McDonald's costs 16.23. Uh, it will pay that 16.23 and then take the 77 cents and move it into a savings account for you. And over time, that builds up. So that's what those two are famous. I didn't know that they were stockbrokers. So that's how you invest your money. Again, this is How to Invest in Stocks, Stephen Richardson. If you liked what you saw, please click the subscribe. I also have a channel for Backyard Musings, which is current events with an edgy commentary. And I also have Law School Dash Essentials, which is for law students and how to outline questions. Law students always need help for their exams and the bar exam. So thank you very much for joining me.